Welcome to everyone who just joined. We're just going to give it just a couple more minutes, or actually just one more minute so that we can get started. Okay, we're about to get started. Hello, everyone, and welcome. My name is Sonia Rockville, and I'm the principal and founder of Bedrock Real Estate Investors, a multifamily real estate firm. And I'm also the treasurer of the Council of Urban Real Estate. I want to welcome all of you who are here today. Before I introduce our speaker, I want to just go over a few housekeeping rules. Ryan has some slides that he's going to be sharing with us. So throughout the presentation, if you have any questions, feel free to put them in the chat. And after this presentation, we will go back and we will answer those questions. So I am very excited to introduce our guest speaker, Ryan Severino. Ryan is the chief economist at JLL, where he manages the economics team and is responsible for global and regional economic research, analysis, and forecasting, as well as property market forecasting. Prior to JLL, Ryan served as senior economist and director of research at Reese in the research and economics department, the team responsible for the firm's market forecasting, valuation, and portfolio analytics services. Prior to Reese, Ryan served in a number of research positions for investment management firms such as Starwood Capital Group and Prudential Real Estate Investors. Additionally, Ryan is an adjunct professor of real estate, finance, and economics at Columbia University and New York University. Ryan holds a master's degree from Columbia University, a bachelor's degree from Georgetown University, and is a CFA charter holder. I also want to note that Ryan has been a great friend of CURE. We are very excited to have him back on stage and to help us understand what is happening in this economic environment right now. So with that, I'm going to hand it over to you, Ryan. Thank you.
Thanks, Sonia. Thanks, everyone, for having me. I am going to share my screen, and then I will spend some time walking through how I see the world from the perch that I sit in, thinking about what's going on in the world today, what's going on in the economy, and then thinking about broadly what those implications are for commercial real estate. Obviously, at a firm like JLL, that matters a lot to us. And the conversation that I've been having a lot lately with internal audiences, external audiences, really centers around this idea that the economy is more resilient than people think. If you just read the popular press, if you're just reading headlines, you might think that it's all doom and gloom out there. And I'm not here to tell you that it's all champagne and roses either. But my job is to be objective about the economy and what it means for commercial real estate. And I try to do that to the best of my ability. And in that context, I think the economy is more resilient than probably the average person perceives it to be. So this is what I really want to discuss with everyone. I'm going to spend some time talking about what happened last year. I'll spend some time talking about what matters this year, and including the crystal ball and what it says. And then I'll talk about, as I said, what it means for commercial real estate. What are some of the things that I'm seeing in the broader economy, and how do those things translate into more direct implications for what's going on in the commercial real estate markets these days? So I want to start with what happened last year, right? How did we get to where we are today, the place that we now find ourselves in? And it's important to remember there were a lot of things that got thrown at the economy last year. In many respects, it was an unprecedented year. When I was presenting in 2021 and I was talking about the economy, one of the things that I said was because it was so strong, we might never see that again in our lifetimes. I could probably say the same thing about the economy last year, but from a different perspective. So here are some of the things that I think were important that really were very, very impactful to what happened in the economy as we went through last year. So first and foremost, I think as everybody knows, we had a severe supply disruption associated with the pandemic. It was just more difficult to produce and distribute goods around the world. The entirety of the global economy felt supply side pressures because of what occurred. Now, to be fair and clear about this, things improved as the year went on. We probably saw the worst disruption to the global supply chain in, I'll call it late 21 into the early stages of 22. And it did improve as we progressed throughout the year. But make no mistake about it, even as we sit here in early 2023, there are parts of the global supply chain that remain disrupted. It can be difficult to obtain products. I don't want to call out any particular companies, but there's a company that you all know that manufactures smartphones, very famous company associated with some fruit. And even though that doesn't really have anything to do with the products they make, and they, in their most recent earnings release, mentioned that part of the reason, the main reason why that they had trouble meeting revenue targets wasn't for demand for their products. It was a supply issue. It was a production issue, actually obtaining and producing the phones that they sell and distribute throughout the world. So we have made significant progress on the supply front in the economy, but we are not out of the woods just yet. So improvement throughout the course of 22, absolutely. But the supply side of the economy still went through significant disruption last year. One of the other big things that we had that really impacted the supply side of the economy was obviously war in Ukraine. I don't know about any of you, but I didn't have Russia invades Ukraine on my bingo card at the early stages of last year. In fact, just last week, I was presenting at our biggest internal conference of the year. And I was recalling last year when I presented there, and I was discussing the situation last year with one of our senior actually our most senior leader in Europe. And he asked me about this. And I said to him, I said, I haven't studied international relations theory as much as I've studied, say, economics. But the one thing I know is that when it comes to major geopolitical events like this, there is only really downside risk. There really isn't a lot of upside risk to a situation like this. And that situation really proved that maxim true over the course of the year. There really wasn't any upside risk. In addition to the obvious catastrophic, loss of life and damage that has been wrought, it had significant impacts on the global economy. It most notably through increases in energy prices and food prices, which caused inflation around the world, including here in the United States, to spike and really peak in the middle of last year, around June of last year. So we were already in a somewhat elevated inflationary situation to begin with. This, unfortunately, only, again, in addition to obviously the real catastrophe, only served to exacerbate the economic situation that we were facing, because it in effect, it turbocharged the inflation that we were already going to be contending with, pushing inflation up to really 4-decade highs in a way that we really hadn't seen in about 40 or so years. And what that did was, as I said, it really pushed inflation in ways that became disruptive to the economy. And I find this instructive and interesting, and I use the word interesting without the positive connotation that most people typically affix to the word interesting. Interesting because we spent the last business cycle, the last decade, wondering if inflation was dead. Those times seemed so quaint when the Fed was actually having a hard time bringing inflation up to its target rate because it had stayed below it for so much of the last decade, the last business cycle. Boy, what a difference just a few years makes. Now we're in the opposite side of that discussion, where we're wondering if the Fed can help bring interest rates back down to its target, or if the economy can do that to a certain extent on its own, which I'll discuss in a bit. But it just goes to show you that it can be somewhat dangerous and precarious to think that things are different. I'll bring up this again, but one of my favorite sayings that I use about the economy is that the two most dangerous thoughts in economics are "this time is different" and "that will never happen again." Anyone who was thinking this time was different about inflation and that we had moved on to a world where inflation didn't exist anymore, well, let's just say that clearly that thesis was clearly disabused by the last few years, and now we're going to work through the other side what it looks like when we're dealing with inflation that's running too hot and is uncomfortable. Now, obviously, as a consequence of this, we went jaywalking last year, and you could see what happened to the Fed funds rate over time. And I like using these images of Jay Powell. I think they're somewhat instructive. In the beginning of the year, I wasn't quite sure what we should be doing. We went into the year with a lot of optimism. We knew rates were going to be going up, but we didn't know quite how much. Then, as inflation started to take off a little bit, with the economy starting to remain relatively hot, but then obviously the situation in Europe exacerbating things, thinking we were going to raise them a bit, and then by the end of the year, we're raising them, and by some measures, the most accelerated pace that we've ever seen, but certainly on an absolute basis, reflecting inflation, the fastest change in the Fed funds rate that we've seen, certainly since that tightening cycle back in the 1980s. Now, this is the classic response to higher inflation. The Fed goes out, or central banks like the Fed go out, they raise rates in response to higher inflation. But it does take time for those higher rates to translate into a response in real economic activity, what businesses tend to do, what consumers tend to do. But what happens on a much faster basis is that asset markets tend to respond pretty quickly. In fact, asset markets will often respond in advance of interest rates changing. As long as they understand that interest rates are going to change, they start to adjust expectations accordingly. They don't sit around to wait for the whites of their eyes, so to speak. They actually make, as you would think, with something forward looking like a valuation, they actually make adjustments in anticipation of change. And that's exactly what we saw last year. There were some very pronounced changes, certainly in the technology market. We saw technology company valuations, both public and private, turn down pretty quickly, because if you are a technology company and your value is predicated on cash flows that are forecasted, I say this somewhat jokingly, but somewhat seriously, 30, 40, 50, 75 years in the future, then it doesn't take a small change in interest rates to translate into a small change in discount rates. And then once you're discounting cash flows decades into the future back to the present, that can have a much more pronounced impact on valuations. The other thing that it did, which is closely related to technology companies, we saw crypto melt down as well, from the peak, say in the fall of 2021 to the bottom that we saw, fairly recently. We also saw cryptocurrencies also getting hit pretty hard. And one of the things that downturns are really good for, they're really good for exposing scandals. Some of you will remember Bernie Madoff from the financial crisis, 2008, 2009. FTX obviously is probably the most notable crisis of the downturn in crypto that we've seen recently. So anything related to technology was really hit hard by this. Again, thinking about crypto doesn't even have cash flows to discount into the future. It's just, the valuations turned down as interest rates started to go up. The outlook probably, I'd say, broadly soured a little bit. In addition to those markets, we also saw a historically bad year for public markets. What I'm showing you on this slide are equity returns and bond returns in the United States over the last 50 years. And you can see 2022, which I have encircled, stands out as a significant outlier. We tend to think of stock markets and bond markets as being inversely correlated with each other. They tend not to rise and fall together. Yeah, they have years where they obviously will behave similarly, but we really don't get performance like you're seeing on this slide, where both the equity markets and the bond markets really had a difficult year. And again, that's because I think, as most people know, higher interest rates will depress bond prices through that discounting measure that I was discussing. But the other thing that happened was higher interest rates soured the economic outlook, which caused equity returns to turn down. And not just technology companies, even beyond technology companies, more broadly in publicly traded equity markets, valuations started to come in as interest rates were getting raised more aggressively throughout the year. And you saw what I think is safe to classify as an outlier year for stock and bond market performance. And again, it's easy to see in the scatter plot of those returns how much of an outlier this actually represents. Additionally, we saw fallout beyond technology and public markets. Certainly, the commercial real estate market had a bit of a dislocation last year, which I'll discuss. But we also saw it in the residential market. The housing market peaked probably early to mid last year and started to turn down. It's not filtering through completely to metrics like inflationary indexes, but certainly we went through a notable downturn in housing markets last year, which is spilling over into this year. So higher rates maybe not yet fully impacting the real economy, but it did not take long for them to impact what happened in the kind of asset economy, the monetary economy. Yet despite all of those things that the global economy and the domestic economy went through last year, several components, key components of spending remained firm in the face of all of that. The three things that I tend to look at when I'm thinking about the underlying health of the economy, not just spending money today, but what it portends for the economy in the future, I look at three key subcomponents of GDP. I look at consumption, the money consumers are spending. I look at the investment in equipment on the parts of businesses. And then I also look at investment in intellectual property on the parts of businesses. And you could see throughout 21 into 22, not coming through completely unscathed, but those components have held up pretty well. There are few quarters in there where equipment spending contracts a little bit, but by and large, those key components of spending have endured pretty significantly throughout the course of certainly 2022, slowing down a little bit from 21. And again, it's not so much that I'm telling you that everything is great out in the economy, but this to me shows signs of clear resilience. Inflation hit 40-year highs as we went throughout the year. We went through the fastest tightening cycle for interest rates that we've seen in about 4 decades in the US. And yet, in the face of all of that, consumers were still resilient, spending money, and businesses were still out by and large spending in those categories that I think, again, not just say something about the current state of the economy, but business confidence about the future. Businesses would not be out, make no mistake about it, businesses would not be out spending money on things like equipment and intellectual property investments if they didn't think that the outlook was going to be relatively optimistic beyond, say, what this year or next year looks like. So that gets me to thinking a little bit about this year. As we've endured everything that the world threw at the economy in 2022, it starts to get me thinking about 2023. And when I think about 2023, I start to think about the consensus. What is the consensus saying about the economy this year? And I find this particular quote amusing. That in a recent poll of economists that was carried out by the University of Chicago and the Financial Times, 85% of economists thought America would fall into recession in 2023. Now, I find this amusing for two reasons. Number one, economists can't agree on anything. If you survey 100 different economists, you will get 100 different opinions on things like what GDP is going to be this year, where interest rates going, what inflation looks like, what color the sky is, what day follows Tuesday, which economist gives the most dynamic, engaging presentations. I have my own opinion on that, but all kidding aside, economists tend to have fairly divergent opinions. So 85%, that strikes me as kind of interesting. The second reason I find this kind of amusing and interesting is that consensus is seldom, if ever, right about things. Whether it's interest rates, whether it's inflation, whether it's GDP, whether it's unemployment, whatever the case happens to be, consensus tends to not be right. So that got me thinking about this year, right? Because one of those two things, I mean, they're not mutually exclusive, but I was wondering if one of those two things was going to prove right, if either was going to prove right. And I asked that because I'm not that dour about the economy this year. In fact, my base case expectation is not that the economy falls into recession. I still think that there is a path to avoid that, which I'll talk about. But let me give you some sense of why I have that view, why I think that's the case. So I want to start on the corporate side of the economy, because the corporate side is going into 2023 in an incredibly strong position, certainly stronger than what it looked like heading into the financial crisis of 2008 and 2009. I think a lot of people have probably heard that balance sheets are in a strong position, that we are basically coming off of peak corporate profitability in the United States. One of the measures that I like to look at, which isn't as commonly cited, is a metric known as unit corporate profits. You could think of it as profits relative to the amount of things that are being produced in the economy. So it's a relative metric. It's not an absolute metric. And I like looking at this because unit corporate profits tend to peak about 2 to 3 years in advance of a downturn in the economy. And I've encircled the last three, let's call them the non-pandemic recessions, because that one was just so unique and idiosyncratic. It wasn't really due to any kind of economic phenomena. It was really due to something outside the economy. So if you look at the last few in the United States, really going back to the late 80s, early 90s, you could see this trend. Unit corporate profits tends to peak in advance, and then it starts to come down, and then eventually we ran into some trouble in the economy. So you see that in the late 80s, early 90s, you see that in the late 90s, early 2000s, and you see that in the late 2000s before each of those downturns. If you look all the way over on the right, we are not yet seeing this metric heading down. Well, we're at about peak level. So for argument's sake, let's say we're at about the peak. Again, that's not to guarantee that there won't be some kind of downturn coming, but it at least suggests that we probably have a longer runway ahead of us than has been suggested by, I think, a lot of those economists who thought it was an inevitability that we were going to hit a recession this year. At a minimum, it speaks to that resilience that I was talking about, and the idea that a recession, at least when you're trying to peer into the crystal ball of corporate America, doesn't guarantee that. And in fact, it's not just this metric. And I know if you've been reading about corporate profits, they've been coming down, but even in the most recent quarter, it's showing this resilience. 70% of S&P 500 companies beat their earnings expectation in the most recent quarter. So it's not as if we are falling off a cliff just yet as far as looking at the corporate side of the economy. Switching gears a little bit, I want to think about inflation, because not just because of the implications it's going to have for the Fed, which I'll discuss, but also the implications that it has for the consumer. And the message that I've been telling people is not that inflation is a non-factor any longer, but it's probably falling quicker than many people believe. In fact, if you look at, say, the last 6 months of 2022, inflation's at about, call it about 2%, which is far lower than some of the scary headlines. If you look at inflation over the last quarter of the year, which is more or less what I'm showing on this slide, is down to about 0, at least on the headline CPI. And in recent months, I know it's not been quite as optimistic as people would have thought, bounced back a little bit. But again, the trend over time, and you could see that in this slide, is that it's coming in, that we are likely past the worst of inflation. It's starting to trend down. You could see around 0. I have those dash lines around plus or minus 1%, because you could see most of the time with some undulation in inflation over time, it's almost always between plus or minus 1%. And we're now back into that kind of more reasonable range of it being sort of plus or minus 1% on a 3-month change basis. What this means is, when I'm thinking about consumers, what I'm thinking about, and again, this is another metric that really matters that you probably don't hear a lot of people talking about, is a metric known as real disposable income, meaning after inflation and after paying for necessities, is the amount that's left over, that real disposable income, is that rising or falling? And I mention that because, at least in the United States, we don't see recessions when that metric is rising. When people have an increase in their absolute spending power on a discretionary base, more discretionary basis, on a disposable basis, what does that do to things? And you could see that this metric bottomed out in June last year, when the consumer price index hit its and other inflation indexes hit the highest level that we'd seen in 4 decades. But since then, with inflation starting to decelerate the way I was just showing in the last slide, and wage growth holding pretty firm, that metric has started to go up again. And I think this year probably bodes well for this metric. Not that wage growth isn't slowing down. We've certainly seen that in the wage data over the last few months. But my general expectation, I think most economists' expectation, is that inflation is going to slow faster than wage growth is going to slow, which should put at least a bit of a floor underneath this. It's going to be hard to get back to say, where this level was immediately in say, late 2021, maybe even early 2000, late, let's call it late-ish 21. But I think there are changes in place that do put a bit of a floor underneath this. And why that matters is because the consumer remains of paramount importance to the US economy, actually to the global economy. I think most people have probably heard somewhere along the way that US consumers represent about 70% of GDP in the US. But if you stripped US consumers out from the entirety of the US economy, and we ourselves were just a standalone economy, depending upon how you measured it, we would either be the largest or second largest economy in the world. Therefore, what we do as US consumers doesn't just hold serious implications for our domestic economy, but certainly holds serious implications for the global economy. And I emphasize that because we as consumers have been doing our jobs. If you saw the retail sales data yesterday, we're continuing to spend money. The one category that I want to focus on here, though, is consumer durable goods. Durable goods are things that capital intensive goods that tend to last a long time. Things like autos, appliances, even some, depending upon how it's classified, it may be some electronics components, things that tend to last a long time. And I emphasize that because if you were going to argue that we were in some kind of bubble, because usually when there's a recession, there's some imbalance, some bubble that bursts that caused the economy to go into a recession. Well, then over the last few years, it would be this, because this is what people were spending a lot of money on during lockdowns. They were spending money once we got through the acute phase of lockdown, which you could see is that big, sort of down leg in the chart. Once we sort of got through that and realized there were things that we could do even pre-vaccination in a safe manner, started spending money on cars to drive around so we could, go eat outside, pick up coffee, spend money on appliances for our homes, maybe, other furniture, things like that. But you could see what's happened. Some of so you see what's happened. It's held up well over time. Some of the most dire prognostications about this said something like, well, once we revert back to some semblance of pre-pandemic norms and we start, going about our lives again, going out to bars and restaurants and discotheques or whatever you cool kids are doing these days, that you are going to see this implode as spending shifted. And to be clear, spending in the economy is shifting. We are shifting back more toward those services and spending less on goods, but it's not imploding. It's not cratering. Consumers are continuing to spend money across categories. And that, I think, was really embodied by what we saw in the retail sales data for January yesterday, that consumers are still spending money on a broad array of categories. Now, that raises an interesting question. Businesses are still feeling fairly optimistic, out investing in the economy. Consumers are still, well, I won't say feeling optimistic, because if you read the consumer sentiment or confidence surveys, that seems that they're not. But I always say, watch what consumers do and not what they say. But again, consumers are out keeping the economy going. What's really propelling all of this? And in my mind, the thing that's really propelling a lot of this is the labor market. In the initial stages of the pandemic and the recovery period, a lot of government stimulus played an important role. But since then, it's really been the health of the labor market that's enabled consumers to go out and spend money, that's driven profitability of businesses. And I could have shown you any number of metrics to demonstrate how tight the labor market is. I'm just showing you two on this slide: the unemployment rate and open jobs. If you haven't heard, the unemployment rate is quite literally about as low as it was when we landed on the moon for the first time in 1969. And yet at the same time, companies are still struggling to fill open positions. You could see I've encircled different periods of time to show you this relationship. As the unemployment rate has slightly gone down relative to pre-pandemic levels, the number of open jobs is actually up. It's up by about 4 million relative to where we were at the pre-pandemic period, from about 7 million open jobs to about 11 million or so open jobs. But I could have shown you other measures. Weekly unemployment claims are also hovering around half-century lows. Wage growth is even though it's, as I said, it's down a little bit, is the strongest that it's been in a while. This is by any reason an incredibly tight labor market, which raises an important question: what's driving that? And it's simple in a sense, but more complex. Very simply, we have excess labor demand. Demand for labor exceeds supply. That raises the important question, why is that the case? The main reason why that's the case, and this is true in both the US and around the world, is because we are going through a major structural demographic change. As the baby boomers are aging out of the workforce, we are not replacing them fast enough. In fact, for the first time in US history, and I mean that quite literally the first time in US history, the prime age workforce, which is people 16 to 64, that's actually declining. It's actually starting to pull back. We are just not in the same demographic place that we have been through a lot of the post-war era, where I think I would objectively argue that we went through a demographic dividend with the baby boomers growing up and entering the workforce, because there are only two ways to grow an economy. You either we're either more productive or we put more resources to work. The main resource that we put to work in our economy tends to be labor. So there's some good news and bad news about this. The bad news is it's a growth constraint, obviously, if we don't have the people to go out to work. If you have to hire someone, it's also a bit of a problem if you've tried to fill an open position. But the other component to this that makes it a little more challenging is it could potentially, and I stress could, I'll come back to that in a minute, make inflation stickier than it otherwise would be, because obviously when there's greater demand for labor than supply, then it pushes up wages and it makes costs a little bit more expensive. But it also potentially makes the economy more resilient, even in the face of that. And that's one of the reasons why I think we haven't seen the economy cratering, even though inflation's been high and interest rates are going up. Because think about what happens during a typical downturn in the economy. Typical downturn in the economy goes something like this. Central banks like the Fed raise rates in order to keep the economy from overheating. When they do, parts of the economy that are the most sensitive to interest rate changes start to have trouble. Technology companies are very interest rate sensitive. Capital intensive companies, like anybody who manufactures autos or airplanes, they're very interest rate sensitive. Or anybody who's just irrespective of industry, who's using excess leverage, could become very interest rate sensitive. So their margins get compressed, they start laying people off, and then that tends to spill over into the broader economy. Somebody who doesn't have a job anymore doesn't spend as much on pizza, doesn't spend as much on dry cleaning, doesn't spend as much on vacations. That cascades through the economy. And that is really what happened through our last three downturns. If you remember with the dot-com boom and bust, very nascent stage of technology, when those people were unemployed, they didn't really have anywhere else to go. If you think about the financial crisis of 2008, 2009, very housing related. Once, at least in the initial stages, once those employees were let go, they didn't really immediately have anywhere else to turn. And then even just through the pandemic downturn, because of the lockdown, we lost more than 20 million jobs, because when people are not going out, all kidding aside, when people are not going out to bars and restaurants and nightclubs and getting on airplanes and staying in hotels and going to Disney World, then there's nowhere else for those workers to go. This cycle is different. Contrary to those headlines, we are seeing layoffs at historically low levels. The one exception to that is the technology industry and relatedly the publishing industry, because it's so technologically oriented these days. Obviously, because of the place that industry occupies in society and the public consciousness, it generates a lot of headlines. But I'd say two things. Number one, it's more of a right sizing and adjustment than a sea of mass layoffs. A lot of those companies overhired during the pandemic and now they're adjusting a bit, but net, those employment roles are still up at those companies by and large. The second thing I would say is, think about technology today. It is so pervasive in our economy. And one of my favorite statistics to cite is that about 60% of people who work in a technology occupation don't, in fact, work for a technology company. They work for a bank, or they work for a real estate company or a healthcare company, something else. That gives anybody who's been laid off in technology a place to go. Now, it might not be the most sexy or exciting company or their dream job, but it certainly gives them more options than what laid off workers tend to see during a typical downturn. And to me, that is the key feature that not just enables the stuff that I've been discussing, but really helps us be resilient, even in the face of higher inflation and higher interest rates, which we see through the first month and a half of 2023. The one other thing I would say, and something that I've been thinking about, I haven't fully modeled this out, but I've certainly been thinking about it. A lot of what happened was a supply disruption, as I mentioned, and we haven't fully worked through that. Most of the inflation that we've seen has really been supply related, not as much demand related, although admittedly that's starting to shift. If, and I stress if, because I haven't fully modeled this out yet, but if putting people to work improves the supply side of the economy, grows the supply side of the economy faster than it grows the demand side of the economy, well, then we should be able to expand the size of the economy, expand output in the economy without seeing a lot of significant wage and inflationary pressure. And to be clear, that's what we've seen up to this point. As I said, we've seen inflation slowing down faster than we've seen wage growth slowing, and both of those things are slowing, which means fear of that dreaded wage price spiral. We don't see a lot of empirical evidence for that. The economy continues to expand, even with inflation at what I would, honestly call somewhat uncomfortable levels. So again, I haven't fully modeled this out just yet, but it's an idea that I've been kicking around a bit, that as we put people to work, if supply is growing faster than demand in the economy, then we can continue to run the economy at these levels. Now, the last thing I'll say about inflation, employment before I move off it, we are below pre-pandemic trends, and there are still issues in the labor market. It's not all Shangri-La, but this is a much more resilient labor market, in keeping with my theme, heading into this year than we've seen heading into your typical slowdown in the economy. Okay, so that gets me thinking about the one thing that people bring up when I mention this. They say, well, what about the inverted yield curve? And I say a few things about the inverted yield curve. First and foremost, the inverted yield curve does not explicitly cause downturns. When short-term rates are higher than long-term rates, that doesn't explicitly cause a downturn. It might make things challenging, but in and of itself, it doesn't cause a downturn. Second thing I would say is, yes, it's been a good recessionary signal, but the lag relative to when things invert can be 6 to 24 months. So it's a very imprecise signal. And the third thing I would say is, if you read the dissertation that was written that about the yield curve signaling a pending recession, the author was talking about real yields, not nominal yields, which is what I'm showing you nominal yields on this slide to show you that inversion. But if you actually look at real yields right now, they're pretty flat, because expectations are for inflation to go down over time. So we're not fully seeing what the author suggested. In fact, despite the Fed raising rates and an inverted yield curve, financial conditions in the US have really been loosening since last summer, last fall. And if you think about the last week's been a little bit, week or two has been disruptive because the economy's shown that resilience that I was talking about. But by and large, financial conditions are still loosening. The equity markets bottomed in about October of last year, and they're up. Across the yield curve, we've seen yields come down. Again, it's bounced up a little bit, but yields were coming down. Spreads have certainly come in, including in commercial real estate, where spreads are probably 25 to 50 basis points narrower than what we were seeing, say, at the heights last year. And even though interest rates are difficult to forecast, spreads tend to be cyclical. So it suggests, if not guarantees, that spreads on commercial debt should continue to come in over time, which would be a good thing for our industry. So despite the Fed raising rates, financial conditions haven't tightened as much as they'd hoped. Again, the economy and markets are taking an optimistic bent, and they're being somewhat more resilient. So that gets me thinking about the outlook and implications. Just a few big things on the outlook for this year. First and foremost, interest rates. I remind everyone before I talk about the outlook for interest rates that there are really good reasons why the Interest Rate Forecasters Hall of Fame is still completely vacant. That said, I'll show you the Fed's current forecast. And I tend to agree with them, not just because they themselves are in charge of the Fed funds rate, but when I look at the economy, it does have that resilience and momentum heading into the year. I think it's probably going to take the Fed funds rate to say 5 to 5.5%, somewhere in that range, before I think the Fed pauses probably around mid-year and then leaves rates elevated for the balance of the year. I don't expect the Fed to start cutting rates till 24 or so at the earliest. I always thought late 23 was probably too optimistic of an expectation about that. And I think the markets have kind of shifted a little bit closer to my point of view. I'm not in that real dour camp that thinks the Fed's going to have to get to 6 or 7% on the Fed funds rate. Somewhere around mid fives will probably feel right to me. It's a little bit higher than the Fed's current projection that I'm showing, but I think beyond that, the Fed really runs the risk of causing a lot of collateral damage in both the labor market and the broader economy especially because I think, as most people know, there's a lag between when the Fed raises rates and when it impacts the real economy. As I mentioned earlier, a lot of the rate increases that we saw last year haven't really filtered through to real economic activity just yet. It's starting to, but hasn't fully found its way through. So I do worry a little bit about the risk of the Fed overshooting. I'm not a Fed basher or a Fed hater, but when I look at the world, I think the Fed is probably the greatest source of uncertainty and instability in the economy right now. If we could just get to a point where the Fed was clear about when they were going to stop raising and the outlook, I think capital markets would respond immediately. As I said, they're anticipatory, so they would respond in advance of that. I think it would do a world of good for commercial real estate capital markets. I think you'd see spreads probably come in even a bit more. You'd see a little more pricing transparency, which would improve liquidity and the transaction environment. We're just waiting for the Fed at this point. I think there's a lot of hesitancy on the part of market participants because they're just simply sitting around and waiting for the Fed to take action. As far as inflation goes, as I said, we very likely passed peak inflation, although no guarantees ever in economics. But I do think that we're likely past peak. We've already seen deceleration since June of last year. I think the supply side of the economy continues to improve this year, especially as we've been hiring additional people. I think demand is going to slow down. The cumulative impact of those rate increases will, I think, more seriously bite the demand side of the economy this year. The other thing that's going to happen, as I mentioned, the housing market has rolled over. Prices have started to decline due to a quirk of how that component of CPI is calculated. It just hasn't shown up in the data just yet. That will start to really hit in the latter half of the year. So I'd expect, more measured slowing in inflation probably through the first half of the year. And then I think as we get toward the middle of the year and the latter half, once we're calculating energy changes off of very high energy prices from last year and the housing impacts start to filter through, I think more meaningful declines. But I don't think it's going to be an easy shift down to Fed target of 2%. I think we probably end up somewhere in that 3.5% to 4.5% range by the end of the year. And then after that, it's going to take a little bit more time to come in. I think that resiliency in the labor market, double-edged sword, puts a little bit of a floor underneath this because wages are the main component of services inflation, and that tends to be pretty sticky. It's probably the stickiest part of inflation, say relative to goods and commodities. It's just going to take a little bit more time. And then where the rubber really meets the road on this, the outlook for the economy, we knew the economy was going to be slowing down. From 21 into 22, we knew that was going to happen, even 22 into 23. I'm not as concerned about whether or not we're in a technical recession or not. We're going to slow near zero this year, I think, one way or another. I think what matters more from my point of view is that this is very likely to be a relatively short, relatively shallow recession that we haven't really seen in the United States since the dot-com bubble burst more than 20 years ago. I think if you're benchmarking a downturn off of the last two recessions, they're both somewhat idiosyncratic. If they're not unique, they're at least scarce. I think this downturn is likely to be relatively short, relatively shallow. I think we skip off the bottom. We're not immediately back to breakneck pace of growth, but we're certainly, I think, relatively quickly growing again in the economy, which portends good things for real estate. Commercial real estate tends to turn around pretty quickly. If you think about the major property types, retail and apartment, which are very consumer oriented, tend to turn around pretty quickly within 3 or 4 quarters of reaching the bottom of the economy. Industrial didn't used to be that way, but industrial has now forced itself into that category. Industrial tends to also turn around pretty quickly. And even office. I'll talk about implications for office in a bit. But the part of the office market that's strong isn't really going through a slowdown the way I think the weaker parts are. So I think unambiguously a relatively short, relatively shallow downturn or slowdown, however you want to think about it, portends pretty good things for commercial real estate on the other side. As far as key risks, some of them are the same. Russia and the situation in Europe is unresolved. High inflation and high interest rates continue to be a feature, not a bug of the economy. We're not fully through supply disruption, especially as it pertains to energy. And then I'd say, technology is still going to be a concern because of how much space technology companies have leased, certainly in the office market over the last few years. So just keep an eye out for that. The two things that I think are a little bit different this year, we're going to have to pay attention to. First and foremost, I think China, their reopening is certainly a good thing, I think, for their economy and the global economy. But U.S.-China relations are the most tense they've been in decades. Right on cue, we're shooting down balloons or other things that are, flying over landmass. So just keep an eye out for that. The two biggest economies in the world, I don't think they'll completely decouple from each other. There are too many linkages. They're too important to each other, but things could get bumpy for a while. And then the last thing I would say is I am not a political person at all, so I don't have any latent agenda when I say this, but the political situation in the US has turned more dour. We now have divided government again, and that's just going to make getting anything done harder. And you've already seen that, with the debt ceiling debate. That's going to be a relatively long, protracted battle that's going to play out. And again, I'm not a political person, so I'm not taking a stance on anything. I'm simply saying for the last couple of years, even the last, sort of 4 years or so, we've had relatively cooperative policymaking in DC. I think that's going to get more contentious moving forward. It's just going to make policy measures that support the economy harder to come by. So let's talk about implications for commercial real estate. First, I would say the situation that we're seeing in the labor market is going to exacerbate the flight to quality in office that we've been seeing. I think, as most people know, the trophy segment, or at least sort of from like class A and above, maybe even B plus ish a little bit, has been massively outperforming the rest of the market. You go down the quality spectrum into the B space and the C space. I heard somebody say that it's going to be a binary market, that it's going to be either good or bad. I think there are more shades of gray in there than that suggests. But I'll tell you something about the office market that I typically say about the retail market, that it's overbuilt and under demolished, that we just have too much space. What we need to do is, certainly if we can continue to build that sort of the new high quality space that everybody likes, but in the process, we probably need to make sure we're building it in the right places, and we probably need to really do something else with a lot of that really obsolete inferior office space that's just not really effectively in competitive inventory anymore. So that's going to have to change. Secondly, consumers remaining resilient supports not just retail, which continues to outperform expectations. We're hovering near broadly in retail historically low levels, and rents are nominally at record highs. Same thing I could say about industrial. It's funny. I have this running joke with the brokers here in New Jersey, where I live and work, that they're running out of space to lease. The industrial market has never been hotter. You're seeing a lot of demand, not from e-commerce tenants themselves alone, although there's some of that, but really a lot of logistics. A lot of the pure logistics providers, the third-party logistics providers, are really driving demand for industrial space. Industrial, really, we are running out of space to lease. Even though construction activities is improving, I would expect to see, minor, well, I shouldn't say minor, some slowing in the industry. There's no way we were going to be able to replicate the incredible pace of rent growth that we saw last year. By our count, asking rents grew at about a 25% year-over-year rate last year. I think it's going to slow materially from that, but I don't think there's enough new development to really stymie rent growth that much. I think the outlook for rent growth in industrial remains strong over the next 3 to 5 years. I do think that when you think about the shift towards services consumption, it does bode well for the hotel sector. Consumers, as I said, are still out spending money. There's a lot of that revenge spending that's going on. Again, even in the face of higher prices and higher interest rates, consumers really want to live their lives. And so I think more than the corporate and more than the business side of hotels, I think the consumer side should hold up, especially with a lot of international travel resuming. A lot of the barriers to international travel are coming down. I think that portends good things for offices and for an apartment, which, for a lot of the last business cycle last decade was the darling of commercial real estate. Demand is slowing down. I think, consternation about the economy. I don't know if you've heard this statistic, but, we now have the highest percentage of young adults living at home with their parents that we've seen really in the post-war era. That has siphoned some of the demand out of the apartment market. But make no mistake about it, we are dealing with a long-term housing shortage in the United States. And I am supremely confident that once the economy turns around, we will see demand coming back for the apartment market, and we will continue to be in a structural housing shortage that portends good things for both the for rent apartment market and even the for sale housing market, which, as I said earlier, is taking some lumps a bit. And then lastly, I do think capital markets should ease in the second. Oh, sorry, that should be 23. My apologies about that. In the second half of 23, once the Fed signals that hiking is ending, I think the first half of the year is going to continue to be relatively challenging, but I do think the second half should improve once we do have more transparency, once we have more clarity on Fed policy, once we have some better pricing discovery and some stability in the pricing market. I think especially once investors realize that inflation is really coming down and that the major concern that everybody fears from an economics point of view is alleviating, I think that should serve as a catalyst for stronger transaction volumes in the second half of this year. And that is my whirlwind tour about the economy and implications for commercial real estate. But with that, I'm going to shut up, but I'm happy to take any questions that I did not address during our enthralling presentation this afternoon.
This is fantastic. Thank you, Ryan. We did get some questions in the Q&A, so I'm going to go ahead and read some of these questions off to you. One of them was, wasn't it the 40% plus addition to the M2 money supply that caused inflation versus the Ukraine war?
So one of the things that we saw in the data was that it was really the initial stages was really supply oriented. It wasn't so much demand oriented. Now, obviously there was an improvement in the demand side of the economy, but it occurred at a time that production was really shut down. The main thing that really enabled that was fiscal policy. Because if you look at the last business cycle, people said the same thing. Oh, the government's printing, all this money, inflation is going to take off. But go look at the data in the 2000s, inflation didn't go anywhere. So what happened was we printed money and then we gave it to people in the form of fiscal stimulus in 2020 and 2021. But it wasn't so much that the demand side got overheated, is that we gave people a bunch of money at a point in time where it was really difficult to get things. Think about how hard it was to obtain a new car or a used car. So as everything else in economics, it's a combination of supply and demand. But I would say the overwhelming majority, at least through the middle of last year, of what really propelled what we saw in inflation was really more of a supply side phenomenon than a demand side phenomenon. That's changed a little bit with the supply situation improving, but at least through the first half of last year, it was really a lot of. I mean, again, we're still having a difficult time getting supply for some things. We're not out of the woods on that yet. So I would say it was more acute 21 into 22, first half of 22 than what we've seen in the last 6-9 months or so. Which again is a lot of why I think inflation is backing off. Rate increases take a little bit of time to translate into demand change. So most of what we saw in inflation last year was really due to supply improvement more than demand improvement.
Great, thanks for that. So one of the other questions was, what are good financial investments for 2023?
I am still a believer in, and I practice what I preach with this, I'm still a believer in housing, especially workforce housing. We just do not produce enough housing in general. Certainly we are not producing enough. I'll broadly call it affordable. When I say affordable, I don't specifically mean rent controlled or rent stabilized, just anything reasonably anything that's those kind of mini mansions in the suburbs and things like that. Certainly, those things are still getting built and sold. But if you think about anything reasonably affordable, what's happening is demand for that is increasing faster than supply is. As the size of the economy, the population continues to grow, as the number of households continue to grow, a lot of demand for that product really, it doesn't change that much. Again, it continues to grow over time. But if you look at the inventory for things like Class BC apartments, it's actually coming down over time. It's not really increasing over time because it's either getting CapEx to a higher quality product or it's getting converted into condos or something else. It's like that old joke. How do you build a Class C apartment? You build a Class A apartment and you wait 30 years. There isn't an easy way to build those apartments because the economics don't work with the cost of land and labor and inputs these days. So I'm still believer in the medium to long run in the housing market. Even even over the next 5 to 10 years, with population growth slowing and the household formation rate slowing down, it's going to take us a long time to fill that void. So I'm still a believer in housing in the short to medium run, no doubt about it.
Okay, great. Thanks for that. One of the last questions that's listed here, and again, if you have questions, please feel free to put them in the Q&A. This question that's here is, given 15% plus office vacancy rates in major cities, how do you justify your apparent optimism for CRE investors and lenders?
Yeah, I think it's kind of a, I don't want to say a tale of two cities. That's a little too punny for me, but it's a tale of haves and have-nots. If you are an investor in that high quality competitive space, I wouldn't be worried about a lot right now. If you're an investor in that inferior space, then that's a different story altogether. And let's be clear about that. That space was imperiled before the pandemic. There was a dearth of demand for that lower quality space even before this mess. I won't name any names, but in the years leading up to the pandemic, I used to go and see a number of clients who invested in that space, and they were struggling with what to do with it. Do they sell it, the dream, to someone else? Do they capex it and try to be competitive? Do they try to convert it? Do they knock it down? There was a lot of uncertainty and consternation about that office space before this. This has just, I think, this has completely tipped the scales, because what will happen is the market will adjust. That non-competitive inferior inventory will get taken out of the market. Some of it get converted, some of it will get knocked down, but what you'll be left with is a smaller office market, but a more competitive, a tighter office market. Because, and we have this internal debate all the time. Should we take that obsolete office space just out of the inventory? Because nobody's looking at it, right? Nobody's looking at C space. Nobody's looking at that lower quality B space. So is that really indicative of the state of the market? If you take that out of inventory, it's not all champagne and roses, but the vacancy rate is a lot lower and the average rent is a lot higher. So I would say the market will adjust over time, and we'll settle into a new equilibrium at probably a lower vacancy rate than what we're seeing today, and a higher average rent than what we're seeing today. But that's going to be because it's not just the demand side of the office economy that's going to adjust. The supply side of the office economy is also going to adjust. So again, if you're in that segment of the market, no, I would not be optimistic about it. But if you're in the more competitive segment of the market, I think that we have not abandoned optimism at this point. I can't envision a world, even with the way that we work changing, where nobody goes into an office ever. If we're still, we're not anymore, but if 10 to 20 years down the road, we're all sitting at kitchen tables by ourselves working, then something else has gone wrong over that period of time.
Thanks for that. And the other question we have here is the real disposable income increase specific to U.S. markets? Is there any other market in decreasing that is decreasing or stagnant?
You're seeing similar things around the world. Maybe not, the timetable is a little different. Inflation peaked in the US earlier, but in the United Kingdom and continental Europe and the Eurozone, we're starting to see inflation coming down, and you haven't really seen a big change in wage growth. So that should be supportive. In Canada, it's similar situation. We're still seeing a strong labor market there. We're almost certainly past peak inflation, probably last fall or so. But because the labor market's tight, wage growth isn't as falling as quickly. So I'd say in most economies around the world, that's the case. Even in Latin America, I was giving a presentation about Latin America yesterday. Where inflation is a lot higher than what we're still dealing with in the US. It's still in double digits. But I would expect there, inflation to be falling, probably faster than wage growth. So it's probably supportive there as well. So I'd say most economies around the world, with some exception, I would expect wages to be falling. I expect inflation to be falling faster than wages, which should generally be supportive of real spending on the part of consumers around the world.
That's great. That's great. We are at the top of the hour now. So we really appreciate all of you joining us today. Ryan, cannot thank you enough for making yourself available and giving us this overview of a not so pessimistic 2023,
No,
which is
I'm more than happy to do it, and I'll just let everybody know. Feel free to reach out anytime. You could tell I'm not a good actor. I can't fake this level of enthusiasm. I love what I do, so I'm always happy to help. Reach out whenever. I'm more than happy to if I can be even remotely helpful.
that's great. We may take you up on that for sure.
Yeah, I'm not hard to find, as my kids know. It's very easy to find me on the interwebs, either on LinkedIn or Twitter or YouTube or something. So a simple Google search, you could find me pretty easily. So feel free to reach out. Always happy to help if I can.
That's great. Fantastic. Thank you. And a lot of thank yous coming from the chat. So really appreciate all of your comments on that. Just before we close, I just want to make sure that I invite all of you to attend our Cure annual fundraiser, which is going to be on March 8th in New York. We have the details on our websites. You're probably getting the emails. We look forward to seeing all of you there. And Ryan, thank you again for this incredible overview. We appreciate it.
Anytime. Thanks, everybody. Have a nice day.
Thank you.